geopolitical friction is no longer a temporary risk premium, it is structurally reorganizing global commerce. As the U.S. military executes another round of strikes against Iranian targets and enforces a strict naval blockade, the shipping channels through the Bab el-Mandeb and Strait of Hormuz are facing semi-permanent disruption. While retail investors view this as a short-term headline, institutional capital is quietly executing a massive rotation into insulated logistics and defense assets. This is not just a tactical shift, it represents a fundamental rewiring of global trade networks. The market is beginning to price in a systemic structural shift that will separate asset-heavy giants from fragile supply chain intermediaries. To understand how this transition plays out on institutional balance sheets, we must analyze A.P. Moller Maersk, ticker AMKBY, the undisputed bellwether of global trade. Maersk operates an extensive global network of ocean vessels, ports, and terminal infrastructure, serving as the physical backbone of international commerce. Their multi-year transition toward becoming an end-to-end integrated logistics provider was designed to capture higher margins across the entire value chain. However, this high-moat model is now being thoroughly tested as long-term ocean transit routes are disrupted, forcing a complete strategic reassessment of asset utilization and route optimization. While container logistics face complex routing friction, crude tanker operators like Frontline, ticker FRO, present a completely different asset profile. Frontline commands one of the most modern and fuel-efficient fleets of VLCCs and Suezmax tankers globally. Their core value proposition lies in their direct exposure to the spot market, allowing them to capture immediate, astronomical rate hikes when geopolitical disruptions force tankers to bypass the Suez Canal entirely and round the Cape of Good Hope. This specific asset class acts as a highly effective, structurally insulated hedge against escalating maritime instability. Looking at recent financial dynamics, Maersk's quarterly statements highlight a sharp divide between nominal revenue and realized profitability. While the ocean shipping segment experienced sudden top-line spikes driven by rising freight rates on the Shanghai Containerized Freight Index, these gains were heavily offset by soaring operating expenses. Diverting massive container fleets around the Cape of Good Hope adds 10 to 14 days to a standard round trip, drastically increasing bunker fuel consumption and crew costs. This demonstrates that margin expansion is not a simple linear function of higher spot rates, it is a complex struggle against operational cost inflation. For Frontline, the quarterly balance sheet reveals a highly optimized cash flow machine. Their low operational break-even rates allowed them to translate sudden spot rate surges directly into substantial net income and capital returns. Operating margins expanded rapidly as daily Suezmax rates spiked, demonstrating the immense operating leverage inherent in pure-play tanker models. This financial performance proves that during acute geopolitical bottlenecks, operators with modern fleets and high spot exposure can capture substantial capital efficiency gains that highly integrated logistics providers struggle to match due to fixed network overhead. Maersk's executive leadership has made their execution strategy clear: capital preservation and asset flexibility are the primary directives. During recent briefings, management emphasized that they are not planning their business around a swift return to geopolitical normalcy. Instead, they are accelerating capital allocation toward dual-fuel vessels to meet strict long-term decarbonization goals, while maintaining a highly conservative charter strategy. This disciplined capital allocation underscores a corporate refusal to over-leverage or overcommit capital during temporary cyclical peaks, positioning the company to survive prolonged periods of trade friction. On the defense side of the ledger, management teams at major contractors like RTX and Lockheed Martin, ticker LMT, are outlining unprecedented backlog growth. The rapid consumption of defensive interceptors, such as Patriot missiles and naval air defense munitions in the Red Sea, is outstripping standard peacetime manufacturing capacity. Corporate guidance indicates a structural, multi-year ramp-up in domestic missile defense production lines. This operational shift represents a powerful policy tailwind as Western coalition allies scramble to replenish highly advanced defense stockpiles, securing reliable earnings visibility for years to come. The broader macro environment is fundamentally redefining the competitive landscape of global trade. With active naval blockades and intercepted projectiles in Middle Eastern waters, over 12% of global maritime commerce is facing perpetual detour. This is not a transitory supply chain bottleneck like we witnessed in 2021. This is a structural restriction of maritime capacity. The competitive landscape is shifting away from low-cost, asset-light carriers toward highly capitalized players who can guarantee access to secure alternative routes and premium terminal infrastructure. This macro pressure is accelerating the structural death of just-in-time supply chain management. Corporations globally are transitioning to a just-in-case inventory model, which requires holding permanently higher levels of working capital and inventory to prevent catastrophic production stoppages. This transition creates a highly supportive structural baseline of demand for warehousing, automated logistics technology, and domestic manufacturing hubs. Companies that control physical, end-to-end shipping infrastructure are gaining immense pricing power over customers who rely entirely on volatile spot freight markets. However, we must conduct a rigorous assessment of the systemic vulnerabilities. The most immediate threat to maritime operators is the geometric rise in hull war risk insurance premiums. Operating within active conflict zones can increase insurance costs tenfold in a matter of days, completely erasing the margin benefits of higher spot rates. Furthermore, prolonged routes around Africa dramatically increase carbon emissions, exposing carriers to severe financial penalties under the European Union's emissions trading system. These regulatory and cost pressures represent a persistent, non-discretionary headwind to operating margins. For the defense sector, the primary risk is not a lack of demand, but rather systemic supply chain execution bottlenecks. Both RTX and Lockheed Martin are actively grappling with acute shortages of rocket motors, critical solid propellants, specialized labor, and complex regulatory hurdles. If these high-tech production bottlenecks cannot be resolved, defense contractors will struggle to convert their record-breaking backlogs into recognized quarterly revenue. This creates a significant risk of near-term valuation compression despite an otherwise highly favorable geopolitical and secular environment. Turning to the forward outlook, global shipping valuations require a rigorous and unemotional reassessment. Institutional capital is rapidly moving past the assumption that maritime freight rates will quickly revert to historical means. We are looking at a higher-for-longer rate environment that fundamentally alters the terminal value of modern, operational shipping fleets. While retail investors remain fearful of cyclical downturns, institutional portfolio managers are recognizing that structural asset scarcity is building a highly resilient floor under maritime valuations and cash flow yields. Simultaneously, the multi-year investment thesis for sovereign defense and national security assets remains highly compelling. As long-term defense spending commitments align with persistent, multi-theater maritime conflicts, defense contractors are capturing unparalleled earnings visibility. This structural alignment provides an exceptionally deep valuation anchor. The intersection of global shipping constraints and sovereign defense spending is creating a unique, uncorrelated asset class that serves as a highly effective tool for institutional portfolio insulation against macroeconomic shocks. In our tactical review, we are placing premium tanker operators like Frontline on our breakout watch, as structural supply constraints continue to compress global fleet capacity and drive up spot rates. Conversely, we are maintaining a close trim consideration eye on retail-heavy logistics platforms that lack the capital depth to absorb prolonged shipping detours and rising spot rates without experiencing severe margin erosion. Navigating this complex macro landscape requires extreme asset discipline and a focus on physical, cash-generative asset ownership. Geopolitical reality is rewriting the playbook for global wealth preservation and capital growth. To stay ahead of these structural capital rotations, you need deep, institutional-grade analysis that looks beyond the sensational headlines. Subscribe to SR Money News and turn on notifications to receive our premium market intelligence. Join our community of sophisticated investors as we decode the macro forces shaping tomorrow's portfolios and separate short-term market noise from long-term capital compounding.